record profits.
Soaring gas prices.
The cost of living crisis. Scorching heatwave.
Natural disasters. How much worse could it get?
It's really no surprise the term Schadenfreude gets thrown around when an oil company is seen to be suffering.
They want their profits at all costs, at the expense of our people and our lives.
And right now, BP is really suffering.
They lost a lot of money and they lost the faith of a lot of investors.
And 15 years ago, it lost a catastrophic amount of oil. And a litany of boardroom disasters since then haven't made things any easier. Just look at the share price change of BP rivals Exxon, Chevron, Shell and Total. Now look at BP. It's the only one of them trading below where it was 5 years ago. And it's attracted something unprecedented.
Bloomberg has learned that activist investor Elliott Management has built a significant stake in British oil major BP.
Even a couple of decades ago, the idea of an American investor taking a stake and forcing the company to rehaul its entire strategy would be pretty much unthinkable.
Yet that's where BP finds itself, amid a fractious realm of competitive disadvantages and a geopolitical outlook fraught with uncertainty.
If we look at the current tensions building up between Russia and NATO at large, will defense expenses, for example, take precedence over climate discussions?
And can BP even survive to find out?
Oh, don't tell me we did it again!
When corporate disaster is bad enough to attract the ire of South Park, you know you've really screwed up.
We're sorry.
But it wasn't always this way.
If it's petrol you're after, BP Super's the name.
BP is one of the most storied, oldest British companies, known for its influence all over the world.
BP, like a lot of the companies that are known as the oil majors nowadays, has its origins at the beginning of the 20th century. For roughly the first half of its existence, BP principally operated in the Middle East and in Africa.
It became British Petroleum in the 1950s, and then through its privatization in the 80s was key for the City of London's economic revival.
But the global oil industry has changed dramatically since then.
If you talk to some people about Shell, about BP, about Exxon, quite often it seems that people have the impression that those players dominate the industry. In reality, the share of BP, for example, is not that large anymore. Nowadays, the company accounts for roughly 1 to 1.2% of global oil production.
Let's just look at Shell for a moment. It's a useful comparison because it got started around the same time as BP and produced a similar amount of oil for many years.
Throughout the 2010s, BP was slightly larger than Shell in oil production, hovering around 2.2 to 2.3% of global production, where Shell was rather like 1.8 to 1.9%.
BP and Shell's market values were on par with one another in 2010, but through disaster and decision-making, they've taken divergent paths in the years since. In mid-March, BP was worth about $92 billion, less than half that of its rival.
BP actually became larger than Shell through acquisitions in the 1990s, but then in 2010 there was a very huge turning point, which I think most people are familiar with.
The oil and gas ignited and the rig exploded, killing 11 people and initially leaving a sheen of oil on the water surface 1 mile wide and 5 miles long.
The Deepwater Horizon oil spill was the biggest event in BP's history. It cost BP more than $60 billion, which it's still paying out.
It meant no contracts with the US government for 4 years in a time where climate became more and more important to the public. That obviously has huge repercussions for your public image, and that also reflects in your market capitalization.
BP shed more than half its value in 2010, equal to tens of billions of dollars, and it's never recovered. After years of testimony and argument, a US federal judge found that the discharge of oil was the result of gross negligence and willful misconduct. It was only BP's first in a series of crises.
The second component was BP's involvement in Russia, because BP had about 40% of its production in Russia, and tensions rose between Russia and the West from 2014 onward.
That's when Vladimir Putin annexed Crimea in a precursor to the full-scale invasion of Ukraine. This chart shows how reliant BP was on Russia, and we'll come back to it later, when it looks very different. After taking over as CEO in 2010, Bob Dudley had struck a deal with Rosneft, Russia's largest oil producer, to drill in the South Kara Sea and each become a major shareholder in the other. But the deal fell apart after it was challenged in court by partners of BP's existing Russian joint venture, TNK BP. Meanwhile, rival Shell successfully snapped up the UK's BG Group in a $70 billion bet on liquefied natural gas. In 2020, Dudley retired.
BP got a new CEO, Bernard Looney, and Looney really wanted to move BP into a different direction.
Bioenergy, EV charging, hydrogen, renewables, our convenience business. We will increase our investment into those transition growth businesses to over 40% by the middle of the decade, 50% by 2030.
This kind of rhetoric was common to oil companies at the time and invited widespread accusations of greenwashing. But it coincided with another development.
The pandemic for BP came at a great time. Boom, all of a sudden for the first time, oil demand dropped by around 10% in 2020 compared to 2019.
And what often happens in oil markets is extrapolation, where short-term events affect long-term outlooks. BP saw an opportunity to double down on renewables, but its prediction in 2020 that global oil consumption had peaked was a huge, if well-intentioned, miscalculation, because just 2 years later, this happened.
Putin chose this war, and now he and his country will bear the consequences.
Many places in the world, especially Europe, moved from wanting clean sources of energy to wanting secure supplies of energy. Not long after, it became clear that if BP and its shareholders wanted to make money, it needed to return to oil and gas.
But BP was about to have to abandon its Russian operations.
Russia's invasion of Ukraine had a devastating impact on BP. The company's production volumes were basically cut in half.
Remember this chart from earlier, showing BP's oil production by country? Look at how Russia changes post-invasion. Meanwhile, Shell's $70 billion bet on liquefied natural gas paid off handsomely as countries had to adjust to a world without as much access to Russian energy.
Shell moved into the energy transition like BP did, but Shell retreated quite quickly from its transition strategy while BP stuck with theirs, and the market has rewarded Shell for its decisions.
That brings us to the present day. Oh, and another CEO, Murray Auchincloss, BP's former chief financial officer. And with some thanks to his predecessors, he was about to be handed a fresh crisis of his own.
Bloomberg has learned that activist investor Elliott Management has built a significant stake in British oil major BP. Sources say Elliott wants to boost value by pushing the energy giant to consider transformative measures.
Elliott is one of the most feared activist investors in the world.
Elliott Investment Management was founded by Paul Singer, who is a Republican megadonor in the US. Elliott tends to buy up shares in a company and demand strong action and quick changes.
When Elliott gets involved, companies sit up and take notice. In almost half a century of investing, they've very famously lost money only in 2 years of their existence. They've shown they can do everything from completely rehauling a board, kicking top management out, or even breaking up the company itself.
With or without activist pressure, one of BP's greatest challenges is its huge pile of debt. A company's ratio of net debt to equity is a vital measure of how much a business has had to borrow to stay afloat. Let's look at BP's. At the end of last year, it was about 40%, far in excess of Shell, Total, Chevron, and Exxon. Saving money to address this became essential. Auchincloss said as much during the company's most recent earnings cycle, promising investors a fundamental reset of strategy, all in the service of growing cash flow and returns.
BP is cutting around 5% of its workforce.
Bloomberg has learned that BP is weighing a potential sale of its lubricants business.
They announced a pivot back to oil and gas after previously planning to move away from it. And they announced a plan to divest $20 billion worth of assets.
The most dramatic and perhaps the most consequential of all of Elliott's demands will be aimed at BP's board and management, we have reported. This means BP's chairman and CEO in particular could come under pressure.
It's an example of how extensive American influence is on UK capital markets. The BP saga exemplifies the worst consequences of big oil, bad luck, corporate disaster, war, and environmental pressure colliding uncontrollably. And now, one of the biggest Wall Street names out there is circling, just as political forces turn away from the climate fight in favour of more fossil fuel.
So the question here would be, within the current geopolitical environment, will climate still play as much of a role over the next 5 to 10 years in Europe? To a company such as BP, this will be one of the most important questions when it comes to its survival.